Good morning from London. I'm Anna Edwards alongside Tom Mackenzie. We're an hour away from the opening trade. Here's what you need to know. Asian shares bounce back after encouraging data on the US labour market. US stock futures are flat after the S&P 500 notched its biggest rally since November 2022. Questioning the Fed's independence, Donald Trump says presidents should have some say over interest rates and monetary policy. He and Kamala Harris agreed to a debate in September. Plus, China's consumer prices come in higher than expected, but seasonal factors played a role as the economy continues to battle the longest streak of falling consumer prices since 1999.
Let's check in on the markets then. On a day, of course, where we're reassessing the appetite for equities after the risk-on moves that we saw across the US yesterday, with the S&P notching the best day, as we said, since November of 2022. The Nasdaq 100 as well, adding gains of 3%. Currently, European futures pointing to a bit more of a muted start, just up 0.1%. What a week it's been. FTSE 100 futures pointing gains of around 14 points, and the US 10-year at 396 after a bit of sell-off on Treasuries yesterday. A bit more moderation in the session so far today. 146 on the Japanese yen, a bit of strength coming through, but for the week, weakness, of course, for the Japanese currency. Just in the session, up 0.2%. The countdown to the opening trade starts right now.
Welcome to the opening trade, everybody. Just under an hour until we get to the opening trade here in Europe. But what a week it has been. And Tom, perhaps that's where we need to start our conversation this morning. Putting the week in some context, the S&P 500 actually now only down 0.5% on the week. After all of that, after all of the angst of Monday, the turnaround of Tuesday, the Nasdaq was up by more than 3% in yesterday's session. And it does seem as if that claims data took on a whole new level of significance, didn't it? It's also always useful as a sort of very at the coalface reading on the labour market. But I like one of the lines from our colleague Edward Harrison on the MLive blog saying the absence of important economic data meant that the US market latched on to claims. And boy, did they latch on to claims.
They really did. It was a reminder of how sensitive these markets are to individual data points. And that, of course, is the point that you were making, given that this is a Fed Reserve that continues to insist it's data dependent. So you get a jobless claims number with all the context around it, because, of course, our team at Bloomberg Economics suggests it's not necessarily the best indicator, because not everyone out there who's unemployed is putting in notice around jobless claims. But nonetheless, the top line number, of course, came in below expectations, one of the biggest drops, I think, in about a year. So that did give that rally to equities and a sell-off in bonds.
Yes, and we're seeing that pushed up stocks in the States yesterday. We're seeing that Asia is carrying on with that baton to a large degree, up by 1.5% in the Asia session. Yes, some of the gains on the Japanese market have faded a little bit, and I saw that JP Morgan cut its Japanese stocks view. But still, we are seeing some risk appetite for equities through the Asia session, and we might get a bit of that in Europe, although US futures are pretty flat. Let's pivot our conversation to the Fed, and we'll start with what former president and wannabe president 2.0 Donald Trump has been saying about the Fed. I think it's interesting here because he's talking about, of course, he said this before, and he continues to say that presidents should have some say on what happens with interest rates, and he certainly hasn't held back. Other presidents since the 70s have held back on these views, left the Fed to do their own thing, but he didn't. He got involved. But I think there is a little bit of nuance here. I'm not sure it warrants the nuance, but I'll add it anyway, is that he thinks he should have a say in interest rates because he thinks he did so well in business that whether he would think that other presidents should have a say, I don't know.
Yeah, OK, so maybe it's unique to Donald that he gets a say over the Trump. You're right. Look, over the Fed, he was very vocal, of course, when he was president. He's also come out and said it would be a mistake for the Fed to cut before the elections. He suggested that would have a political element to it. Of course, the Fed's insisted it is politically apolitical. It's going to look through that, of course, but it's coming. The Fed is also coming under pressure from some on the left of the Democrats as well to say don't heed the warnings of the Trump of the Republicans. So they're getting pressure from both sides, but it's a reminder that this is a presidential candidate who certainly wants to have that lever of control over a Federal Reserve, which of course historically has played that independent role. So yes, potentially significant.
And we will get to some of the lines out of the Fed. We've heard from a couple of Fed policymakers, Barkin and Schmid. We'll get to those comments later in the programme. But Tom, thinking of inflation, let's go to the China story, because on the one hand, this looked like a better than anticipated number. It was, but there are all kinds of seasonal factors in here, we're told.
Yeah, so the inflation data out of China has taken on that extra prominence for very different reasons versus the US and Europe, which is that investors and economists want to see that inflation ticking up because it's been so subdued, and it's suggesting, of course, an indicator of just the weakness of the Chinese consumer. The top line number, as you say, coming in higher than all the estimates at 0.5%, 0.5% increase in terms of CPI, consumer price inflation. But you lift the hood and you see a lot of that is seasonality because of weather conditions, so food prices went up. But when you think about hard goods, so things like smartphones and TVs and hardware, actually prices there, mobile phones and cars, continue to fall. And then factory gate prices, well, they have been in deflation for about 2 years. So, as you say, you lift the hood on that data, is not looking as promising. And what it all means is that we should expect further action from policymakers in Beijing to try and support that economy.
And we'll see whether we get the action that pleases the market, because we had that plenary and therefore on the sort of political side, we didn't get enough in the market's view. The PBOC has cut rates, haven't they? That was a bit of a surprise to investors, but not enough to lift stock. I mean, Chinese stocks, turnover on Chinese stocks at a 4-year low in the month of July, so suggesting, there's a lack of interest in getting involved there, it would seem.
And this is the continued narrative, isn't it? There's a lack of conviction still in what policymakers have up their sleeves in trying to support this economy. There's been a lot of rhetoric, some implementation, but still not enough to assuage those concerns or indeed to turn that economic data around convincingly.
OK, let's tell you what is coming up on the programme in terms of the guest conversations we're going to be having this morning. 7:15, so in around 10 minutes' time, we'll speak to Aaron Kapteyn, Chief Economist at UBS Investment Bank, who will be joining us around the table, and we'll get views on the US economy after the data of Friday and the data of yesterday. What do we know about the US labour market? 7:30 a.m, Ema Daly joins us, emerging market macro strategist at NatWest Markets, on the latest in the unwinding of the carry trade. So many EM currencies did so well out of that carry trade, and then were left vulnerable. We saw that this week. Where are we in that story? Then at 8 a.m, Luke Barrs, Global Head of Fundamental Equity Client Portfolio Management at Goldman Sachs Asset Management, joins us to talk about where we are on stocks, as we saw so much read across from that US data and the moves at the BOJ into stocks this week. Certainly worth tying up the week in a nice little bow.
Some really fantastic, genuinely fantastic guests on the show today. So that's the run-up and the line-up for the guests that you should be tuning in for. For the rest of the week, as we look ahead as well, just to flag for you and put on your calendar. So the Paris Olympics, the closing ceremony is going to be on Monday. It's probably been seen as a very successful Olympics. Of course, it started with those attacks in the railway lines and the challenges there in terms of the logistics and cyber attacks. But it's turned out to be broadly, I think most of the people take away from this, it's been a very successful Paris Olympics. So that closing ceremony, of course, on Monday. Then you have a bit of a pause before the Paralympics. OPEC comes out with its oil market report as well. That's going to be interesting, of course, given the Middle East tensions. We were speaking to Carol Knackley, an oil expert, saying that she thinks oil will remain in that $75 to $80 level for some time. Then in terms of a gauge of airline demand over this key, of course, vacation holiday period, we've got Heathrow July traffic figures. We have unemployment data out of the UK on Tuesday. We have ZEW survey on Wednesday out of Germany. That's always interesting in terms of building out a picture of that economy. UBS earnings, that's going to be fascinating, isn't it, in terms of the financial space and to what extent they're continuing to build on the success around integrating Credit Suisse and any challenges there. And then when it comes to inflation, really central, of course, given all the ruptures that we've seen in repricing around the Fed. You have the US and UK inflation data out on Thursday. Then on the earnings front, Walmart's a touch on the consumer there, Alibaba, JD.com in China reporting, and then India's Prime Minister Narendra Modi giving his first speech of his third term. We also get the University of Michigan Consumer Sentiment Survey and UK retail sales. We get US retail sales as well. So I think it's important. US retail sales next week, but also the inflation data out of the US.
Yes.
We talked about the sensitivity to these markets on and around those kind of data prints.
It's inflation week, certainly on both sides of the Atlantic in the Anglosphere, because we have UK inflation, we have US inflation, so we'll certainly focus in on those. We might see in the UK that inflation number ticks up a bit, but that'll be fuel and base effects, and the Bank of England has already started cutting rates, so we'll see what happens on the services side, perhaps. Let's tell you some of the other stories that we are covering this morning. The US, Qatar and Egypt are calling for Israel and Hamas to resume ceasefire talks on August the 15th. It comes as American F-52 fighter jets arrive in the Middle East as the region braces for a possible retaliatory attack by Iran. Spanish police are hunting for the former Catalan president, Charles Puigdemont, who made a dramatic return to Spain after a 7-year exile, despite facing an outstanding arrest warrant. His return could pose a challenge for Prime Minister Pedro Sanchez, who last year clung onto power thanks to deals with regional pro-independence parties, including Puigdemont's party. Eli Lilly is narrowing the gap with rival Novo Nordisk in the race to dominate the obesity market as it expands its supplies of weight loss drugs. Lilly reported $1.2 billion in second quarter sales of Zepbound, smashing Wall Street estimates of $819 million. Yes, that was an impressive set of earnings. The stock at one point, Tom, up by 14%. That battle then between Lilly and Novo around the uses of these drugs, really fascinating to watch.
Yeah, it's really interesting, isn't it, given that Novo came out with their earnings and they're still struggling to kind of supply that demand. And so there was a bit of sogginess in terms of the sales numbers for Novo. But that competition is really heating up. And, of course, it has implications beyond the drug space. It has implications for food makers as well, fast food chains having to think about these obesity drugs and to what extent they are becoming prolific. Now, coming up, Donald Trump, back to US politics, and Kamala Harris agree to debate. They have finally agreed. We're going to take some details around that. The race, of course, for the White House heating up. We're going to take a closer look at what is at stake for both of those candidates. Plus, just a few days left of competition at the Paris Olympics. We're going to go live to the French capital to discuss whether the event has been a success and what kind of legacy it will leave. Up next, we will also dive deeper into the markets with Kapteyn, chief economist at UBS Investment Bank, joining us around the table. If you have any questions of your own for our guests, send them to us on IB Plus, BBTV Go. This is Bloomberg.
I think you've got some time in a healthy economy to figure out whether this is an economy that's gently moving into a normalizing state that will allow you to, in a steady, deliberate way, normalize rates, and stick the landing, if I could use another balance beam analogy. Or, is this one where you really do have to lean into it?
That was the Fed's Richmond President Thomas Barkin on how the central bank policymakers still have time to figure out rates before the rate decision meeting. Seems to be operating at the place where central banking and the Olympics meet as well, which is nice. Let us continue this conversation about where the US goes on rates, about the US jobs market. Kapteyn joins us, chief economist at UBS Investment Bank. Very nice to speak to you. Nice to see you here on a Friday. Let me start with the job story, if we could, because we've been on a big journey, it seems. And I'm not sure what we've learned, if anything, about the US labour market over the course of the past week. Friday spooked investors with some time to think about it. Monday looked even more frightening for investors, but still about the jobs report and some other factors. And then yesterday, the claims data, it's only about 1 week, but it seemed to give a lot of comfort. What do you take away from all of this?
Yeah, so we think, what happened over the last week is largely a head fake, right? So the weakness in payrolls, we think, was largely Hurricane Beryl and the auto plant maintenance, right? So you could sort of... You could see it in some of the household survey data. So we saw an enormous increase in the number of people who were off work for weather reasons. They have to sort of apply a ratio to figure out how much that pushed down payroll. So we think it's about 40K. But there's a lot of uncertainty there. So I think we have to wait for the state-level payroll data on August 16, and then we'll sort of see how big Texas was in that in the payroll weakness. In the claims data, where we have higher frequency data, we already knew that there was this big jump in Texas claims. But we also had big jumps in Missouri, Michigan, which is the auto plant maintenance. That's now starting to unwind. We haven't fully unwound it, right? So I think Texas is now maybe another 5K or so to go on the initial claims data. And so I think once you take that all out, the picture you get is that claims were not increasing. They were actually going down. They're trending down, right? So the labor market was not weakening. It was strengthening. And the payrolls data is sort of running at a very steady, 3-month moving average of somewhere between, if you take out the hurricane effect, something like 180, 185. So that really sort of suggests that this was an overreaction to perceived weakness that is not really there.
Yeah. Right? OK, so it was a bit of a head fake then, the whole experience. And then that takes us to the Fed and how the Fed reacts then. They have a lot of time to think about this. I mean, we do have Jackson Hole at the end of this month, so I suppose we do need to be aware of that, 22nd of August. So there'll be a lot of words given to us by the Fed, a lot of conversations had about where policy goes. But thinking about what Jeffrey Schmidt said, just in the last 24 hours, he says, and this is about rate cuts, we are close, but we are still not quite there. Or this is rather about inflation and getting to the inflation target. There are still those hawkish voices, I suppose, suppose.
Yeah, so I think the thing to remember is that, if you step back, they're sort of getting their forecast, right? The forecast was they would grow about 2% this year, right? They got that in the first half of the year. They have an unemployment forecast of 4.2 next year, which I think after next month's payrolls release or a household survey release will be sort of there. And with that forecast, in June, 11 out of 19 only wanted to, cut once this year, right? So that was the starting point. Now, of course, the issue is that when you look sort of intra-year, there is a slowdown on the way, right? We're going from about 3% second half of last year to about 2% first half this year. I think the second half of this year, we're going to be running at something like 1.5, closer to 1. And so the question is, yes, you're getting your forecast, but even when you get the forecast, you may not quite like it when you get it, because it feels like, well, where's this going, right? And I think that's partly what the market is reacting to. There is, how big is the slowdown that we're needing to reprice? And so I think it's an open question now how they are looking at the labor market data, how concerned they are by it, and not just the labor market data, some of the weakness they've seen in the survey data. And then indeed whether they, start to sort of move from the one cut scenario to something that's higher frequency. So we think that's happening, right? So we think, the June dot plot is sort of obsolete. We think, at a minimum, we're going to get September, December. And now I think for us, the question is, do you also get November? And I think that's becoming potentially increasingly likely, but that's sort of it. And that means the market is overpricing, the next 4 meetings by at least a cut.
OK, because quite right now in your notes to us, you're looking at two cuts. You put the question mark there over November, but you're seeing so far locked in 2 cuts, 25 basis points, total of 50 basis points, which is half what the market is expecting. What does this US economy need in terms of stimulus from the Fed or a less tight monetary policy?
Well, so it's a good question. So I don't think it's, they wanted things to cool down, right? Running payrolls at, 12-month average of over 200K is not consistent with a soft landing, right? So you're going to ultimately, so I think the interesting feature of the U.S. data is that the household survey, which is generating the unemployment rate and which is triggering the sum rule, is running nearly 200,000 below the payroll data, right, over the last 12 months. So had you had as much employment growth in the household surveys in the establishment survey, we would not, unemployment would have not gone up. It would have basically still been sub 4. And so we'd be having the no landing debate again, right? So I think one thing to keep in mind is that, which set of labor data do you believe? And I think the Fed, in its recent communication, has sort of been discounting the household survey and put more weight on the payroll data, which is closer to where the census is. And the census is the ultimate truth of where the U.S. labor market is, and that's sort of around 180K. And so if that's the case, you don't actually need a whole lot of stimulus, but you can start to unwind that excess restrictiveness, which I think is what they're sort of communicating.
We've got the inflation data out of the U.S. next week. Is the Fed reaction function to that inflation data two-sided? As in, if it comes in a little higher, do they kind of look through that? Comes a little softer? Are they more sensitive to a miss versus a beat? How are you thinking about the balance within the Fed's reaction to that?
I think it will almost be entirely a reaction to the owner's equivalent rent data, right? We've had one, that's what they've been waiting for, right? So you cannot land a 2 if owner's equivalent rent is printing, 40 basis points a month. If you print 30 or sub 30, then you can land a 2. They've had 1 month where that has now stepped down to that level. So I think they will want to see that now sustained. I think the risks of that are sort of even-handed, or they're sort of two-sided. But if they continue to get sort of these benign OER prints, then it's a green light to start cutting in September. If they don't get that, then, that's obviously makes it a lot more complicated, because then again, you're not really sure whether you can just worry about the employment side of the mandate or have to also still keep worrying about the inflation side of the mandate.
OK, so a lot comes down to the rent then. So we wait to see whether we get that sort of green light for the Fed in the data that we get next week around rents, around housing costs, and what that does to the Fed expectations. Thinking about what other central banks are going to do from here then, Aaron. We've got the Bank of England and the ECB have already started their path of cutting, but I guess the pace at which they cut will be at least curious about what the Fed does. What is the read across?
Yeah, there's always safety in the herd. So when everyone's cutting, it's easier to sort of, speed up your own cutting cycle or just deliver the cut. I do think, though, the ECB, I think, is just locked into a quarterly cycle, right? I think it's a bit of a pretense that this is really, I think there's widespread consensus on the council that they're going to, the first 4 to 6 cuts are sort of baked in and are pretty easy, and they're going to go at this quarterly pace. It's very difficult for me to see them accelerating from a September and a December and then a March sort of cut, right? And if the Fed, signals that they're now finally starting, or they're going to go, they're going to go in successive meetings. I don't think that then puts, faster cuts for the ECB on the table. So ECB for me is just September, December. The BOE is more tricky because I think their data, it was obviously a very finely balanced decision. Data has not been that great, right, on the inflation side. So we think they now wait to November,
and
right?
It could go up next
week.
It
could go up, and so so
well
that
flagged
one,
and telegraphed.
Yeah, so that's just a tricky one where I think they also clearly want to start cutting, but they have to proceed more slowly. I think certainly than the Fed. I think the Fed's inflation data looks a lot better than the UK's inflation data. And so for them, it's also sort of a quarterly cycle at this stage, and then you sort of start to accelerate next year. Into next year
on BOE, you're expecting 175 basis points, 175 basis points of cuts by the BOE next year, with some caveats around that. What are the main risks to that view? Is it inflation, or is it the economy and potential resilience there? Well, they're linked, but it's mostly inflation, right? So, and it does feel a little aggressive. So it's so I think the narrative that the Bank of England has is when you look at sort of harmonized inflation data, it looks like the US, the Eurozone, and the UK data is behaving identically, right? There was basically this big supply shock that's unwinding, but the unwind starts later in the UK because we had this big energy shock, and because of the pricing mechanism, it took longer to sort of unwind that. And so if you just wait long enough, then the UK will look just like the Eurozone and the US. That's the narrative. But I think what's different is that the wage data has behaved quite differently. I think so that's sort of a concern, right? Where we're seeing, in my mind, softer sort of wage dynamics in the Eurozone and in the UK. And ultimately, you're going to worry about that in terms of the stickiness of inflation. So I think we do need to now see in the next sort of 4 or 5 months a real moderation, I think, in wage momentum in order to then get to a benign inflation environment, which then allows you to sort of catch up to your models and cut as much as we forecast.
What is thinking about the whole week then, Aaron, that we've experienced here and the way that markets were spooked, and we went through that head fake, as you describe, around the US labour market story. Where is the risk from here, then, that this happens again? Could it be the CPI print? it seemed to be the confluence of weakness in the US data and the BOJ hiking rates, the fact that both of those came together, that put pressure on carry trades and dollar yen, that then meant we had sort of fallout in many asset classes. Do we see things like that on the horizon again, that kind of timing? Yeah, there's sort of various things. I don't think the BOJ hike was a big factor, to be honest. You just look at how much did the market reprice after they hiked, like not very much. And it was really, the yen carry trade was largely, half of the U.S. rates move happened before last week, right? And that was sort of post the CPI print on July 11. And we started to sort of get a big rates rally. And then with the weak employment data, we got another, 35, 40 basis points of rally. And then you sort of cross this critical threshold that is, unseeable, where everyone sort of panics, and then you start to unwind it. Now, that bit, I think, is sort of quite straightforward to sort of see how it could reverse, right? I think what happened the last week, you could sort of undo that, but then you still have what happened before last week, which is that we are getting now to the Fed cuts and a different type of pricing regime. I think it's much more difficult to sort of figure out what's going to happen in equity, because I think not everything that happened was just that weak payroll data. We were in the middle of an unwind of the AI trade. Okay.
We should be pricing a lower growth environment that was not, I think, priced by the market. So even if it's not a recession, how much do we rally back?
Aaron, thank you very much indeed. Aaron Kapteyn, Chief Economist at UBS Investment Bank, on the head fake of this week. Coming up, we're going to take a deep dive into emerging markets with EM macro strategist Ima Daly. That is next. This is Bloomberg. Welcome back. Happy Friday. 30 minutes from the start of the opening trade. Here's what you need to know. European futures currently pointing lower by around higher by around 0.3%. Sorry, US futures are pointing a little lower after the gains that came through yesterday. Worth noting that, of course, the S&P notched its best day since November of 2022. Eli Lilly soaring, and Nvidia back as well with gains of around 6%. European futures looking to very modest gains so far, around 0.3%. The FTSE 100 looking to add just 13 points.
Let's check in on bond markets as we digest the week in which we saw, in the words of Aaron Kapteyn from UBS Investment Bank, a head fake. This is where we are right now. So we do see these yields coming down a little bit bit, a bit of buying of bond markets here in Europe. Over in the United States, across the Treasury curve, I can see those yields just a touch lower this morning. Let us think about where the week has taken us in currency markets, because, of course, prior to this week, with the weakness of the yen, we'd seen the carry trade boosting a number of emerging market currencies. Then fast forward to this week, the carry unwind, and some emerging market currencies might have looked vulnerable, those that had higher yields, those that were boosted by that carry trade. We've actually seen the emerging market FX index, though, at its highest level in 2 years. This is an index of currencies. Growing bets the Fed will cut rates over the coming months are weighing on the dollar, easing pressure on central banks in developing nations to defend their currencies. So there's a lot in the mix, a lot to talk about with Emma Daly, EM macro strategist at NatWest Markets. And Emma, thanks for being with us this morning. So it's been an incredible week. If we start on the carry trade story first off, how has your thinking shifted as we've gone through this week, as we've seen threats to that carry trade come through from either BOJ policy or the weakness in the US labour market data? How is your thinking around some of the currencies that have been moved by that currency trade? How has it changed?
Yeah, I think we were always of the view that this was an overreaction, that you had this kind of unfortunate confluence of events, right? That weak U.S. labor market report, and then obviously the BOJ, and this obviously kind of very uncoordinated global monetary policy. So we really saw this capitulation of carry trades that had just been built up over years. But kind of our point of view was always that this was a market reaction, overreaction, and that there was opportunities. I think it was interesting, in the rates market, you saw, markets just rationalizing that, increased Fed easing means increased EM central bank easing. Even the fact that, most of them are actually coming to the end of easing cycles, or they saw big sell-off in their currencies. So that wasn't necessarily what they were going to do. I think you have a clear out of positions, you achieve valuations, and where the fundamentals are still good. I think it did create a lot of opportunities if you had the nerve to keep going into them.
Sticking on the carry trade element of it, though, I mean, it's difficult to know exactly how big that trade is. We've seen estimates, I think JP Morgan just yesterday saying maybe 3/4 of it has been unwound. What are you hearing in markets? I know your focus is on the EM side, but what are you hearing in markets about the size of it and how it's endured this week?
I mean, it's so hard to tell. There's no perfect gauge of how long these have been built up for. I think, Mex Japan is the clear one, which has been just built up over years, that clear carry differential. But it's interesting that you've had a significant rebound. I think there's still carry differential to be picked up there, and where it's justified, we're not going to close that gap immediately. So I think we've seen a washout of positioning, and I think incentives are still there for investors to get back in.
What's the dollar role in this, given the repricing around Fed expectations, but also on the counter? If you see haven flows into the greenback, I mean, expectations you're going to get 100 basis points of cuts. The linkages between dollar expectations and the outlook for the rest of the year and EM.
So it was interesting that you saw almost like two different types of performances in the dollar. This was a risk-off move, and yet the dollar underperformed, right, against the G10. But in EM, you had EM sell-offs against a weaker dollar. So I think it was quite a nuanced view. And I think, you're looking at Fed easing in kind of a different global context. You're looking at amidst like concerns over a recession, concerns over capitulation of carry positions. So I do think the dollar direction isn't as clear. I think this was really a reflection of market positioning overall, and the dollar was almost the net effect of that. So
on that clarity, are you getting clarity from the BOJ? The messaging seems to be quite mixed, because if we're thinking about, of course, the carry trade, we have to have some idea as to where the BOJ goes next. I mean, to what extent are the global markets extra vulnerable to further hikes coming through from that Bank of Japan? Do we know what the game plan is and how markets are likely to adjust to that?
I think when we've seen kind of future volatile or past volatile episodes of markets, it's always been central banks that have kind of, underscored markets or supported them. And I think you've seen that from the Bank of Japan, but we're going to see it in a different way this time, right? It's going to be central banks not feeding markets fear. We had the Bank of Japan coming in and basically saying we could slow the rate hiking cycle. Basically, we're not going to deliver what's priced in. I think that's the best thing that central banks can do right now, even when it comes to the Fed. We're not going to deliver 150 basis points over, to the end of the year, basically kind of reining back in market expectations instead of feeding that fear and feeding that risk of recession.
You have some interesting thoughts to moving on from the dollar, pivoting on the dollar story and what might happen politically in the United States. You have some interesting thoughts about what's at risk, really, for Eastern European states and therefore their currencies, if we were to see another Trump presidency, the vulnerabilities align with the politics, don't they, in your view?
Yeah, absolutely. So I think we've seen some investors asking questions. I don't think they're necessarily putting on those trades right now. It's obviously a while until we get any kind of Trump president in power. But I guess, what does Trump mean for this new era? And I think, the global situation has changed. We've got two conflicts going on. We've got a much weakened China. And I think the big thing here is Trump's foreign policy. I think he said two things which are really key, which is he's kind of questioned the U.S.'s ongoing commitment to NATO. And it's also clear that he wants a swift end to the conflict in Ukraine. Unfortunately, a swift end to the conflict in Ukraine could mean them ceding significant territory to Russia and could be seen as a defeat from Ukraine's side, and it really risks emboldening Russia. And we think really the most vulnerable party is Poland as a NATO member on Ukraine's western border, and obviously as a former Soviet Union member. We have seen reports of destabilizing events in Poland. I think there's a risk they escalate further on a Trump presidency, and you see that price.
Yeah, this was really fascinating, and I have to say this has passed me by, and obviously a little concerning as well. But you're talking about even the Central Bank of Poland starting to message around the risks, the military risks that are posed potentially to Poland by Russia, and how they're thinking about that in terms of monetary policy. So how do you, because you're also talking about the Hungarian foreign and how Hungary and Orban is positioned vis-a-vis a potential President Trump. So how do you play zloty forint within that dynamic?
Yeah, I guess, sure, Poland tough.
Is it as simple as that?
The trade, I mean, it's high carry. But, I do think I think you need to get closer to the event to price it in. But I do think we've seen very different kind of geopolitical stances from the two countries. Definitely Poland, if you look at its NATO expenditure, it is just ramped up spending. It's now almost double, the NATO's prescribed 2% of GDP, where Hungary has barely increased their expenditure at all. I think Hungary is taking the diplomatic stance. It's kind of playing the EU, the US. It's trying to be almost like the mediator between the US and a new EU. And also it's kind of been seen as kind of the most supportive of Russia within the EU. So I think you've seen very different tacks from those two, and I think that could play out in the currency space.
Of course, I'm sure everybody would hope that we'd never see any of the action on the ground that would prompt some of those trades to pay out. Let me ask you about a different region and go to Asia, because we had some inflation data out of China today. So with your emerging market hat on, your thoughts on where the Chinese story takes us, because the CPI number looked a little hotter than had been expected, but lots of seasonal factors, as we were talking about at the top of the programme, mean that the general consensus seems to be still concern about deflation in that economy. And then you think about stimulus for that economy. That gets easier if the Fed is also cutting, I suppose. So link the two for us, the Chinese and the Fed story.
Yeah, I think it's kind of a dangerous environment for China that, obviously they are very dependent on external growth, and these concerns about a slowing U.S. economy, even though we think they're largely overblown, but it is very vulnerable to a global slowdown. There is room for it to ease more, but I think it's always been, reluctant to do those like mega rate cuts. We do think, China has a lot of kind of structural issues, and unfortunately it's a long-term structural downturn. I don't think there's a quick fix, and I think China has learned the lessons of implementing quick fix solutions like large credit stimulus before. So I think it's kind of the global economy getting used to the fact that China is no longer going to be the driver of global growth. I think that has regional implications throughout the whole of Asia, but it certainly means that, we think it's going to be a stable China, a slowing China, but not one that is your driver of global growth that it was before.
A stable and slowing China. A China that, of course, imports a lot from LATAM. And I know you've got a call on LATAM currencies as well. Where are you seeing opportunities there? Yeah,
we really like Brazil. We think, we've obviously seen, a big move in the currency. It's kind of cheaper. It's priced in a lot of the fiscal risk. It's come to the end of its monetary policy easing cycle, and yet interest rates are still extremely high. So it offers investors a lot of carry. So I think that's one that really stands out to us as a good value play. Monday.
Okay, there's still some carry trades out there looking at Brazil. Ayman Dele, thank you very much indeed from NatWest Markets, doing a tour of the world for us with a view, of course, on the LATAM space, the role of China, and, of course, how we're adjusting around that carry trade linked, of course, back to Japan. Thank you. Now, coming up on your stocks to watch, we're going to focus in on Hargreaves Lansdown. That's after a consortium agrees to buy the investment manager. Big day for Hargreaves Lansdown now, and that's coming up along with a number of other stocks in focus. This is Bloomberg.
I do believe there's resilience in the U.S. economy.
We do not yet see any sign of having the economy move in recessionary territory.
There have been several calls for U.S. recession. In fact, they've just turned out to be corrections with a resumption of growth.
I do think that we're getting a correction here after a very strong run in the markets, and that might be healthy.
We don't see a recession coming soon or coming. Actually, we think that the economy is still strongly set.
We probably all have to live with more volatility than we are used to. But overall, I think the trend is our friend and the trend is showing upwards.
Ahead of the elections, obviously, maybe the market is a little bit muted. But all in all, the United States was always a market which was quite resilient.
The U.S. economy is a little bit stronger than people are giving it credit for, and the consumer will come back as the economy continues to strengthen.
The economy will chug along and we probably won't see a recession.
A few of our guests, of course, discussing the risk of a recession in the United States. Let's get the thoughts of our Markets Live executive editor, Mark Cudmore, who's with us to talk about markets in 3 minutes. And, Mark, let's once again ask questions about resilience in the US economy and cracks in it. And I suppose it's the cracks that have really dominated the headlines last Friday and into Monday. But yesterday we got a little bit of reassurance from the claims data playing an outsized role for markets.
Absolutely, and it shows how kind of structurally problematic this market is, not this economy, that we saw such an outsized reaction to what is normally a second-tier print. It's a volatile print, and, you know, it wasn't necessarily particularly out of line given that volatility. So this shouldn't have been an amazing number, but yet we saw a very big market reaction. And that gets to the point here. There's, you know, the recession risk fears got completely overblown over the last couple of weeks. We went from a month ago to being completely complacent to suddenly panicking about a hard landing where there's very little sign of that data. The Atlantic GDP Now Fed tracker has us tracking at almost 3% growth. It does not look like we're anywhere close to a recession. And therefore, unless there's something suddenly on the horizon that I'm just not seeing any sign of yet, I think that all these panicked rate cuts that are priced in the market look completely bonkers. The Fed might get away with maybe one rate cut, but maybe not anymore this side of Christmas.
Possibly one rate cut. Aaron Kapteyn of UBS saying that this was a head fake as well. So agreeing with you on that front, Mark. Talk to us about how this all ties into the rebound that we saw, pretty pronounced rebound in US stocks yesterday. What do you read from that as you kind of point to some of the tensions in these equity markets at this point?
Yeah, I think this is really important. Equities is very rarely an exact encapsulation of economic strength in the short term. Now, obviously, they're linked over the longer term. And I think that the market in August will stay volatile. I think the power of the rebound yesterday, the largest, the best performance, daily performance since November 2022, but still down in the week, shows a market which is now going to whip around a little bit more. So I expect that we're going to see some more losses in stocks in the next coming weeks, but not dramatically so. I'm not suddenly bearish stocks. I think that overall this will probably provide better opportunities to buy stocks for the year end, in fact. I think that'll come in a backdrop, though, over the coming weeks as we reprice yields higher, and that's why stocks are going to be under pressure over the coming weeks. So economy is fine, but stock market just got a bit of ahead of itself, got a bit more volatility ahead.
So that's your view. The economy is fine then, Mark. But what are markets pricing? And when we look at different markets, bond markets, equity markets, are they pricing the same things?
They're most certainly not. So bond market is pricing a pretty firm landing. You know, a very clear recession is what the bond market is pricing. And, you know, we're paring back from that, but we still got more to pare back from that. On the flip side, stocks were very clearly up to a few weeks ago pricing no chance of a landing, and still probably pretty close to a soft landing. At the moment, they are not yet realigned. Stocks are pricing growth to be okay. Bonds are pricing growth to be pretty bad out there and much worse than is the moment. Which will it correct? I think it'll be bond markets that correct to stock markets, and I very rarely favour equity traders over bond traders.
Mark, thank you very much. Yes, we remember this. We remember this about you. Mark Cogmore, our Markets Live executive editor with thoughts on markets. Remember, you can get all the analysis. The Markets Live team, they're there. They're blogging all the way through these market sessions for you on the terminal. MLIV Go is the function to use on the Bloomberg terminal. Let's get an update on stocks to watch. Joe Easton from our equities team has been poring over the details of some M&A this morning then, Joe.
Morning, Anna. So starting with Hargreaves Lansdown, a group of private equity investors has agreed to a £5.4 billion takeover of the UK financial services company. Now, this is a group including CVC, Nordic Capital and an Abu Dhabi investment fund as well. Now, it does represent around a 50% premium to where the stock was before news of this potential deal was announced. And today was the deadline for a final approval of this agreement. However, if we look back further on Hargreaves Lansdown stock, we can actually see that the price isn't particularly high given the long-term trend that we can see over 5 years. That stock is down around 48%. They have seen a lot of competition from the likes of Vanguard and also the other rivals like AJ Bell as well. So some investors might not be too pleased with that, but it is a big premium on where it was around 3 months ago. Then we're also looking at Generali in insurance and investment over in Italy. Second quarter profit falling at around 25%. This is as the company faces higher payouts for natural catastrophes, particularly flooding in a number of European countries. But this is one of the better performing European insurance stocks recently, as they have been ramping up their dividend payments and also focusing on some higher margin insurance markets as well. But this does look a little bit negative. We might actually see a bit of a decline in that one this morning. Then we've got one broker move to bring you. We're back in the fast food takeaway. Just Eat Takeaway gets a new overweight rating. This is out Morgan Stanley. Now, Morgan Stanley reckons that New York fee caps could soon be raised, so there's a limit in New York on how much these companies are allowed to charge for deliveries. Market share is stabilising as well in the UK and Ireland, partly due to groceries. Apparently, some people buy their groceries on Just Eat Takeaway. I don't know who they are, but somebody is. They do like this stock. They do actually prefer delivery, but they also have an overweight rating on this company now, and they are one of several banks with positive views on that stock. If we can bring those up, potentially, might not be able to, but take my word for it. There we go. 15 buys, 4 sells, actually. Not looking great on the sell front, but 15 buys. Morgan Stanley likes Just Eat Takeaway.
Joe, thank you very much. Our equities reporter, Joe Easton, with all you need to know and a few of his own views on the customers of those businesses. Let me go to one of the stories then, Tom, that we were just hearing about from Joe, which is really interesting. That deal for Hargreaves Lansdown, a number of private equity bidders and others in the mix there with this now agreed, this now done deal. It would seem this is a business that was set up in 1981, and by Peter Hargreaves and Stephen Lansdown, and quite a sort of poster child for things that happened in the 80s in the City of London. So that's quite fascinating dynamic. But in terms of the here and now in the markets, I think there's a couple of things that are interesting. One is UK assets being cheap, being bought up and being taken off market, which is what we see here when they go into the hands of private equity. And we see private equity all over the UK space, from Britvic to the Royal Mail owner to Darktrace. So there's lots of that going on. But this also fits in with a broader theme around private equity that our colleagues have been writing about in the United States, about the amount of dry powder that these businesses have. So looking at some of the big North American PE firms identifying a $720 billion war chest in the hunt for deals. And if rates are coming down, that's the crucial factor. So they could expect more deals.
So we're talking about Apollo, we're talking about Blackstone, of course, KKR, and as you say, sitting on all of that dry powder, chomping at the bit to be able to deploy that. We know they've been under pressure precisely because of the higher rate environment. They haven't been able to find those opportunities. And a number of their investors, institutional investors, have been actually pushing to get some of their funds out.
They need to get things sold,
longer-dated funds. But now we're in this environment, you get those rate cuts, and maybe you really get PE coming to the fore with that dry powder. So expect, maybe brace for deals. I mean, certainly that's what we're hearing from executives.
Yeah, and if we do see those rates come down, we could see that. And trying to return some of the money to investors is part of the driver there as well, and trying to just get deal flow happening again. Let's talk about tech.
Yeah.
What's the tech line we need to watch in Europe?
This is one of the pillars of the upside that we'd seen year to date in terms of equities that started to crumble last week in terms of the earnings story, and question marks about whether or not that AI theme is starting to be challenged, the monetization, the capex and all that kind of thing, along with, of course, the BOJ and the softness in the US data. But this was one of the pillars, AI, and it started to look a little soft. Well, TSMC is coming out with some numbers that suggest that the AI theme has further to go. This is, of course, the contract manufacturer, the largest contract manufacturer in the world for chips, with clients including NVIDIA and Apple. Top line is revenue rising 45% in July, suggesting 45% in July, suggesting that the demand is still there. They are continuing to churn out these chips for their clients. Look, Apple says they're going to see an upgrade cycle because of AI later in the year. The market around smartphones has started to bottom, and then you've got demand still coming through, and AMD was flagging that. They've upped their sales target. So the momentum is still there, at least for the hardware part of this, this sector.
And that's interesting. So from a US perspective, the customers of this business, the customers of TSMC, this bodes well for them, doesn't it? From a European perspective, the suppliers to TSMC, the likes of ASML and the others that supply this giant chip maker over in Taiwan, they could also be in focus as we watch how this plays out for markets. Then we'll continue to focus in on the tech sector. Let's have a quick look at where we are on the futures story then for European stocks. Just 6 minutes away from the start of European trade, and the futures picture looks a little bright. We've got Euro Stocks 50 up by 0.3% or so. So we do expect a little bit of upside. US futures looking flat this hour though. This is Bloomberg. A few minutes to go until the opening trade here in Europe. Welcome back, everybody. This is the picture then. This is the handover from the US session of yesterday into our European story. We'll come to that in a moment. But take-off Thursday, certainly the way that we would describe what we saw stateside in stocks. We were up by more than 3% on the NASDAQ by the close of trade. So some real strong momentum coming back into US stocks yesterday. Monday's mayhem, turnaround Tuesday, the whipsawing of Wednesday. Yesterday we saw this take-off then. The US futures suggest we might have a flat Friday. I promise we'll stop playing this game next week, but it's been fun whilst it's lasted. This is the picture that we had on European stocks yesterday here in the white line. Really the US picture, as you just saw there. We caught some of that in European session yesterday, but maybe there's a little bit of upside we still have to factor in from that, and that is what we're seeing here. Certainly we'll keep an eye on tech stocks. Yes, we got that strong performance on the NASDAQ yesterday. That's certainly a factor, but as I say, some of that factored in already. Also those TSMC numbers, we'll watch those. Euro Stocks 50 futures then up by 0.3%, Tom, this morning.
OK, Anna, with a brilliant rundown in terms of the weekly branding as well on a day-to-day basis. We need to make that a theme, definitely. In terms of your stocks to watch, Hargreaves Lansdown in focus, not for the earnings story as much as for the fact that this is now in focus around some deal-making. CVC, Adia agreeing to buy Hargreaves Lansdown at a 5.8% premium, so we watch that stock at the open. European semiconductor makers as well, the likes of ASML, Infineon over in France in focus, given the decent numbers coming through from the contract manufacturer TSMC in terms of sales there. And Generali on the earnings story, a miss. Some challenges there in terms of claims around storm season. Germany, we know, and flooding there was a factor. Some of the stocks to be focused on, Anna.
Yeah, we've had a lot of earnings from the insurance sector this week, so we'll see how those Generali numbers go down with the market. So European equity markets just getting started then for this Friday session. Flat on the FTSE right out of the gates. We are expecting to see a little bit of that upside then. Perhaps some of the tech names could move a little higher on the back of, as I say, that read across from the United States, but also some of the TSMC strength we saw. We got the Stock 600 up by 0.2%. The IBEX is pretty strong. First thing this morning, up by 0.4%. So a little bit of strength coming through. How long that lasts is, of course, a different question. Will we see that flat Friday? That's what the US futures picture is suggesting. The DAX just opening on the back foot, and the CAC 40 up by 0.2%. These markets look a lot calmer than they did in the earlier part of this week. A lot less volatility, for better or for worse, Tom. But this is the picture then for European stocks right now, up by 0.4%. 1.5% as many of the data points of the week are behind us, and we look ahead to some really important data coming up next week.
Yeah, inflation data out of the UK, inflation data out of the US as well later next week, along with retail sales. The jobless claims number, of course, coming in lower, the lowest print we've had in about a year, so that gave and led to that optimism we saw stateside yesterday. But I think you can stick with the Anna branding around Flat Friday for now. Across the benchmark then, just gains across the European stock 600 of around 0.3%. ASML then, one of the tech names in focus given the optimism we've seen from TSMC, the provider, of course, ASML, of these lithography machines to that contract manufacturer. Gains of just 1.3% so far in the session. Generally, another stock that was in focus for us, taking a bit of a hit across your sectors. Going to pull that up for you right now. Basic Resources at the top of the list, gaining 1.4%. Travel and Leisure also posting gains of a little over 1%. Tech is in the mix near the top of the list, up 0.6%. On the downside, food and beverage taking a bit of a hit, just down 0.2%. You've got about 8 or 9 sectors in the red right now. In terms of your individual movers, some names, of course, in focus for us today. Look, we've been talking about Hargreaves Lansdown, a takeover there, so we'll look at that stock. Currently gaining 2.4%, that premium coming through in terms of the bid, the takeover offer, and we'll see, of course, if that deal gets cemented. But so far, investors are rewarding that news and are generally down now 2% on the back of a miss around earnings. And ASML, as I mentioned, in the tech space, up 1%. You're seeing gains as well, just 0.5% for Infineon over in Germany.
Yeah, really interesting that Basic Resources lead us higher. The focus on base metals has been negative of late. Weeks of losses in some of those underlying resource prices, and that has been weighing on the sector. Travel and Leisure getting another day of gains then. Yesterday it was the leisure, and it certainly is the leisure again today, rather than the travel that leads us. It's all that betting on all of that sport that apparently lifts that sector. Joining us now to talk about where we are on these markets after that week that has been, Luke Barrs, Global Head of Fundamental Equity Client Portfolio Management at Goldman Sachs Asset Management. Luke, really nice to speak to you. Thank you for coming in. We spoke last hour to Aaron Kapteyn, UBS Investment Banking Chief Economist, and he was saying that this week's just been one big head fake when it came to the data and what we've learned about the US economy. Have you learned anything useful about the strengths and the cracks in the US economy this week?
Well, look, I think the starting point here is there's been a lot of volatility. It's been data-driven, but actually the underlying strength of the US economy is still there. We've seen GDP growth annualized at 2.8%. So even though there's weakness in the labor market or the jobs prints, actually the underlying health of the economy seems okay. And so, yes, the market had to digest that and it had to feed into what was the Fed likely to do going through the rest of this year, which is an adjustment in terms of how we're looking at it today versus maybe a week or two ago. But actually the underlying health still seems fairly robust.
So if we think maybe concerns around the US economy are overdone, where should stocks be? What kind of landing in the US should they be pricing?
Yeah, so we think, look, soft landing economically is still the high probability outcome. Most of our current activity indicators still say we're going to trough out at 1 to 1.5% GDP growth. So this isn't recession where we have a real shift in Fed policy. We're going to see some normalization in rates. Our expectation now is we could see 3 cuts through the next 3 months to the end of the year. And the big question is whether the September cut is going to be 25 or 50. What that means for stocks is actually, one, we've taken a lot of the froth out of the market in the last week that was maybe there in parts of the market where the fundamentals were trying to keep up with that pace of momentum. But actually the underlying health of the market still seems fairly robust. Where we're looking at right now is, can we buy some select tech names where the profitability, the cash generation is very robust and high, and the multiple has come back to us, and actually really into the small cap space, where we think the normalization of rates that feeds through into the interest expense, because this is floating rate debt, and the adjustment that can drive in the US economy should be very helpful for what is a still undervalued asset class.
OK, we want to unpack some of those calls, particularly around tech. But in terms of your view, and I just want to meditate on that take around September and whether you get 25 basis points or 50 basis points and how that ties into your call around small caps. Is 50 basis points more beneficial in terms of re-accelerating or reviving that rotation trade back into small caps, or would it smack of panic and concern about the health of the economy that you still see as facing that soft landing scenario?
Yeah, so let's just be very clear. I don't think there's panic in the sense of the Fed having to do something intra-cycle where we're actually having to see them come out and make an adjustment before that September meeting. But that 50 basis points would be an outcome if the data was still weak on particularly the job market. And so whilst we wouldn't say that's necessarily a definitive outcome, we think the Fed is going to be data-driven in the run-up to that. Now, how that plays into equity markets and specifically small caps, I don't think it has a huge bearing. Because simplistically, what we've been waiting for on the small cap side, and thinking of this more as a medium-term trade into the asset class, is that normalization in rates, because this is an asset class that, one, is heavily US domestic economy linked, and so anything that is positive in terms of monetary policy and drives the US economy growth rate should be favorable. and it's an asset class that has really suffered because of that higher lending rate and the fact that actually a lot of the small cap space, the SME space, is dependent on floating rate debt. And so as you normalize that, that should be very beneficial for margins, should be good for bottom line.
So that's a medium-term call rather than a tactical call on small caps US. And is that your clear regional preference when it comes to small caps? It's the US versus Europe.
At this stage, we do see a lot of opportunity across both. They're very heterogeneous asset classes, a lot of individual names we can find, but we think the cyclical upside in the US small cap space is very attractive. Now, what I would say, just as a data point, if you look over the last 20 or 30 years, from that point where the Fed has started to cut rates historically, you get a 12 to 15% outperformance of US small cap relative to large cap. And we're at this point of peak concentration in the US market. Obviously, we've normalized that a little bit in the last few weeks, but ultimately we're still seeing a big differential in valuation between large and small cap. And so catching up to a degree, we saw that in July. It's normalized in the last week or so, but actually that can be a really interesting starting point for a both 12-month but also 36, 48-month trade.
Yes, and thinking about that time horizon, that takes us through some US politics, doesn't it? That kind of time span. And I guess a lot of investors are trying to invest for that kind of time span. And so they need to make sure that their portfolios are resilient to whatever might come their way. So how do you think about US politics? And I'm thinking in particular about some of the really popular themes that investors have thrown themselves behind. For example, AI, and maybe that stays intact. But around US manufacturing, around power grids in the United States, all of these trades, do they stay in place regardless of the views on climate, for example, of who inhabits the White House?
No, we actually wouldn't say that. I think there is a degree to which the last month or so you have seen a little bit of correction in the US market of people have digested a more clear and parallel race in the US election, because I think we'd seen, obviously, the outcome being a very likely Trump victory had become the normal expectation. So that's adjusted a little bit, and so people have had to factor into some of those trades you mentioned over the course of this year. Now, in terms of the longer-term themes, US re-onshoring, especially of high-end manufacturing, so, for example, semiconductors, is a structural theme that I think is bipartisan. If you look at the capital that's being invested via US CHIPS Act, if you think about what you need in terms of power supply as a function of AI model development and what you're seeing in terms of capital investment on IRA, these are things that are going to continue regardless of what you see on the political outcomes in November.
So even if the IRA, for example, is revamped under another president, you think that these investment themes that it sort of is the poster child for, they stand?
US re-onshoring of manufacturing in some of those areas like semiconductors, we are very strongly of the belief will continue. On the power generation side of things, and especially around the renewables investment and the infrastructure and grid investment, again, we think that's critical for those AI development stories. It also is interesting if you actually unpick where that investment is going, it is largely into red or purple states where you've got a little bit more of a political lever into why would you pull that back if it's economically beneficial to some of those areas. So we think, again, that's a trend that will continue. We see a lot of individual opportunity at the company level, and this is just really the early stage of that cycle.
On generative AI, we have a reminder today from TSMC that it hasn't run its course in terms of the demand, at least for the hardware part of that story. Where do you invest within that ecosystem? Where are the opportunities? Is the focus on the hardware, on the B2B part, or the B2C stuff?
Yeah, so Tom, I think what we've said over the last 2 years is AI is transformational. Generative AI changes the way we operate, and so there's going to be a significant amount of winners that come out of that. But we also have to recognize the amount of capital investment that's taking place means you're going to get some pretty catastrophic losers as well. What we've seen thus far is it's the enabling technologies, the hardware businesses that have benefited from that significant uptick in capital investment. Your large hyperscalers are $800 billion of capex out of $1 trillion of S&P capex this year. So that is really a key driver.
For that extending out?
Now, I think that's a few more years where we're seeing that investment in model development. I think there is a little bit of a normalization coming, as we've seen in the most recent announcements and discussions from some of those hyperscalers, that will weigh a little bit on some of those hardware technology businesses. So actually, as we look at our portfolios, we've been trimming some of the positions within that as a function of where valuations have got to, and as a function of potentially more competition coming into that space. Now, I think as you extend it out over the next 3 to 5 years, the real question you have to ask is who in the software space is going to be able to utilize Gen AI in a way that enhances their product offering. And at the moment, where the market is having a little bit more challenge is trying to disentangle who that's going to be, because it's not yet clear.
Right, yes, and I wonder, that's really interesting, because I wonder what you're looking at to give you clues as to when this turns from just this big capex story into something that's really delivering at the top line and then dropping through to the bottom line for some of these businesses. And I don't really have a sense of the time scale involved in that.
Yeah, and I think clearly the market was wanting to see more, because you'd had on the enabling technologies, the hardware side, a lot of evidence that it was driving top and bottom line. And to a degree, you look at some of the earnings announcements we've seen in the last few weeks, the market is negatively assessing an inline earnings print because we're expecting to see constant upgrades. And so I think on that front, there is more to go, but we've got to be a little bit sensitive to that cycle. It is still a supply and demand driven model, and we're going to see some more supply coming in. Now, I think on the software side, it is a challenging discussion. What we're trying to do is think about who are the winners and the beneficiaries independent of who succeeds in that space. So if you think a little bit more tangentially and you say, right, cybersecurity is a theme as we increase the prevalence and reliance on some of these technologies, again, becomes something that's a structural investment.
Yes, you see, well, that was interesting because I remember a few months ago we were talking about actual diversion of capex spend, or rather tech spend, actually, from cybersecurity into AI. I think we had some numbers out from some cyber businesses that disappointed at the time that NVIDIA was really flying, and people were saying, oh, this is a reallocation of tech budgets. But you say that the two will go alongside each other.
I think they have to. I think we know that cybersecurity investment and the strength of an individual company's technology ecosystem and architecture is going to be crucial to their long-term success. So yes, there's been a little bit of cyclical normalization because some of that capital investment has had to go into keeping pace on that AI model development trade. But actually, medium term, we still think the cyber trend is here to stay.
Look, just looking back at the week that was, and we're in a position now, we're hearing of a number of voices saying, look, this is all a head fake. But there was that real panic on Monday. If you want, you're still constructive on these equity markets. If you want to put a defensive trade in play, where does that take you?
Well, so I think a couple of points. One, we have seen defensive, high-quality businesses outperform. They've lagged for much of this year. And so you have seen some outperformance in those areas where, look, in a period of panic and stress, they should do relatively well. Now, what we're trying to look at more holistically is where can we find strength in fundamentals? Because actually in the last couple of days, yes, we've seen a correction and that move upwards, but it's been fundamentally driven. And so actually market is looking at where businesses do have strong earnings outlook, can turn that into positive cash, and actually can deliver for underlying shareholders. Now, I think just more macroeconomically or globally, the area that we're finding a lot of interest, and interesting in terms of how it's traded in the course of this week, is India, where you have macroeconomic visibility of 7 to 8% real GDP growth over the next 5 to 10 years, and an underlying domestic demand-driven economy that's feeding into the capital market. And so, yes, it's a little bit tangential from everything we've talked about thus far, but that's a market that we think is very resilient. Yes, there's economic linkages through the commodity markets, and if we see a big spike in oil, that will always weigh on India in the short term. But actually, if you look at what's happened in the last week, that still feels really healthy.
OK, Luke Bars from Goldman Sachs Asset Management on the relative resilience of India in this environment, and a call around generative AI as well, continuing to be a place to look for those investment opportunities. Luke, thank you very much indeed. Let's check in on the Core 6 then this Friday, of course, and they've been challenged as well in this volatile week. And we check in on some of the pricing action coming through. You can see ASML, of course, is in the mix. The linkage is there to the optimism and the sales numbers coming through from TSMC, of which, of course, it is a major client. ASML then up 1% so far in the session. A couple of other standout names, Novo Nordisk, Eli Lilly. Wow, the shares surged yesterday on how they're positioning around these obesity drugs. Novo Nordisk, of course, the key competitor, gaining 1.3% so far in the session. Just one of those Core 6 in the red. Nestle, not by much, just down 0.1%. Let's check in on some of the other individual stocks on the move with Joe Easton. Joe.
So we can see Hargreaves Lansdown shares coming up closer towards the bid price that they have agreed. It's about £11 a share. Now, this stock was trading around £8 a share for the past couple of years. But if we go back to the pandemic, it was almost at £18 when the real peak in trading, online trading at home was. So it is below that, but a decent premium over the past year or so. Now, the other one we've brought up here is Evolution. This is in Stockholm, the gaming gambling company. Our bureau out there reporting that a billionaire has taken a 5% stake in this. It's a US-based billionaire. We're seeing a little bit of a gain there, but the big one, Hargreaves Lansdown, up around 2%, a 50% gain over the past 6 months or so. Then in terms of earnings, some decent moves coming through. Generally, this one hit by those claims on natural catastrophes, particularly flooding, as you were discussing earlier. That one is one of the worst performers in Europe today. And on the upside, we've got Leg Immobilien, and this is over in Germany, real estate, seeing a bit of a rebound in some of their property valuations. That could be a potential marker for that sector going forward. And then Larxis in chemicals, also in Germany, doing a bit better in terms of some of their volumes. But we have got Eutelsat over in Paris getting hit today. That's the worst performer underperformer on the Stock 600. They're reporting weak orders in one of their internet infrastructure businesses. This is a satellite company. Recently did a deal in that space and seeing some weak numbers out of them this morning. So some pretty good moves for what is a bit more of a quiet day in terms of earnings today. But we have got some good movers on there. In terms of Italian banks, news out of local press today is that Italy might be looking to tell banks to give more money to customers who have savings accounts with them in terms of passing on the interest rate increases. That's sort of something we've seen over the past few years, but it seems to be a new issue over in Italy. But we're not seeing too much reaction, actually. Most of those stocks moving slightly higher with some of the broader financial sectors today. And I'll check in on the chip stocks. You mentioned TSMC, Tom, with that massive jump in orders in the latest month, up around 45%. Potentially that's feeding through into some of their clients like ASML, also BE Semi. Infineon, meanwhile, there is comments out of this company today saying that they're looking to do potential M&A, saying that they could have a couple of $2 billion to spend. That is interesting from them. They had some results recently, but green on the screen in terms of the chip makers this morning. In terms of your best performing stock, we have got Just Eat. We mentioned earlier the takeaway company is overweight now. This one at Morgan Stanley. They like it on potential reduction in fee caps in New York. Also the grocery business, and that stock up 4.7%. Morgan Stanley is overweight on that one. I'm going to get to JP Morgan because that was the next one. They are overweight on Galderma. You might remember this one is the company that L'Oreal took a stake in recently this week. It's the injectable cosmetics company over in Switzerland. JP Morgan goes overweight that one, and it's up 2.8% over in Zurich this morning.
Joe, thanks so much. Joe Easton with a rundown of some of the stocks on the move. A lot less by way of earnings this morning. Fewer companies giving us their earnings reports, but still plenty of stocks on the move. A bit of M&A in the mix. We also have some macro drivers to think about in Asia coming up. China's CPI picks up, but demand concerns persist in a gloomy sign, perhaps overall for the Chinese economy. We'll discuss that next. This is Bloomberg.
Welcome back to the opening trade. Happy Friday. 20 minutes into the session. You're seeing modest upside coming through for European stocks, up 0.3%. US futures have turned as well into positive territory. Some data came through from China. It was welcomed by the markets. Then they gave up the gains, and the CSI 300 ended down about 0.3% because the headline number came in higher than expected in terms of inflation. That's what policymakers want to see, an increase of 0.5% higher than expected. But you lift the hood and you realise that it's not all that it necessarily seems when it comes to China's inflation trajectory. Let's get more then on this story with Bloomberg's Balazs Pence with the details. Balazs, what does this data then tell us about the current state of China's economy and whether or not consumers are feeling a little bit more optimistic?
Well, as you said, the whole name of the game in China is demand. And like you said, when the number first came in, it seemed very positive on the surface, CPI beating expectations finally. But when we drill down, we see that that was a result of food prices rising, which was almost entirely driven by the weather. It's been a very hot and wet summer in China. So when we look at the products that actually help us measure demand, like cars and consumer electronics, smartphones, and appliances, we see that those prices are actually still falling. And as we saw, core inflation is actually the slowest since January, and producer prices are still on a downward trajectory. So that suggests all of that put together tells us that demand still continues to struggle in China.
Right, so demand continues to struggle. And so how will policymakers respond, Balazs? We've seen the PBOC attempt to do things. We've seen plenaries take place where policy announcements were made, but market voices suggesting it wasn't enough. So what are policymakers thinking?
It certainly appears that Chinese consumers have so far been impervious to the stimulus efforts. It's widely expected that the response will come in both the monetary policy and the fiscal policy front. In monetary policy, it does look like the PBOC has more room to cut, especially if the Fed moves aggressively. There are some analysts who now expect as many as 3 more rate cuts in China. And there are other things they can do. There could be more immediate measures, like an adjustment in banks' reserve ratios. On the fiscal front, The government last week announced a 20-step program to encourage more spending, to encourage more consumer demand. Unfortunately, we don't yet have a lot in the way of details that tell us about the shape of that package or how the government intends to fund it.
So a question is, and this has been a question all year really, Balázs, as you know, is whether or not these measures are actually going to work, because we've heard the rhetoric from Chinese policymakers, we've heard and seen some of these steps being implemented, but so far he hasn't really moved the dial. What is the expectation from you, the team, investors, economists, as to whether or not these measures this time will actually make a difference?
Well, as the evidence shows us, it's really hard to move the needle on the short term. And so far, like you said, the measures that they have undertaken have not had a huge effect. Certainly, we do know that the government has stepped up borrowing, so they do have a healthy war chest if they do want to embark on more stimulus. And the conventional wisdom is that it will take something quite impressive to change consumer sentiment. But if that does happen, there is a chance that consumers will start spending more, opening up their wallets. For now, though, it looks like the gloom is here to stay.
Okay. Thanks so much. Thanks, Balázs. Bloomberg's Balázs Pens with the latest on the Chinese economy. Let's pivot from the Chinese economy to Chinese diplomacy, shall we, and soft power. And yes, we're back to talking about pandas again, a topic we have visited in the past, Tom. It seems that a new home has been created for some pandas coming from China, on loan, of course, as they all are. We've had that conversation before as well, at San Diego Zoo. I was interested in the detail that Ken Griffin and others at Citadel are partly responsible for funding this return.
Yeah, so we don't have a number from Citadel, or from anyone, in fact, from the zoo in San Diego, which, by the way, is a fantastic zoo if you ever get the chance to go. But he is apparently supporting this effort. So the diplomacy is important, of course, when it comes to pandas. You have to wonder how long they're actually going to be there, given the politics of the US and what happens after November, of course. I also have a question as to whether or not we should be spending all this money protecting pandas, frankly, because they're cute and cuddly, but as a creature, they're just pretty rubbish. So they have to eat 40 pounds of bamboo a day. Bamboo's only found in certain regions, of course, in Sichuan, around Chengdu. I've been there, I've seen them. They're lovely, but they don't do much for the ecosystem. They're very, very bad at breeding as well.
They are.
And if you spent more of that money on things like, let me give you some examples, the yellow-faced bee. Ever heard of them? The Snake River salmon. They need our help. They're facing extinction.
You're making the point that we shouldn't just look after the cute and the cuddly.
Yeah,
is
exactly.
that the thing?
That's my campaign.
That's a serious point. Ken Griffin apparently does a lot for the conservation of Komodo dragons and iguanas as well. He has places named after him in the United States for conserving these creatures. So
OK, Griffin's doing his bit.
There we are.
Around conservation and panda diplomacy as well. They're the pics. You can't get too many pics of the pandas.
You can for Tom, apparently.
Even if they do need to be just...
Yes. Careful how you end that sentence. Coming up, it was a bumpy start to the Olympics. We'll look at the major sporting moments, of course, and what will be the legacy of the Paris Games. We have the closing ceremony taking place this weekend. We're not quite done with the action. What on earth will I be watching in the late afternoon after European markets close? After this week, all I've been doing is watching the Olympics. So we will talk about the au revoir in Paris to the Olympics, and we'll see where the city has benefited, what it has gained. This is Bloomberg.
This is the opening trade. We are 30 minutes into the Friday session. European stocks currently up 0.3%. And here's some good news. If you are on Wall Street or invested in an investment bank, or working in an investment bank, I should say, because Wall Street bonuses, according to our reporting, set to jump by as much as 35% this year. And bankers who help companies sell debt expected to see the biggest payouts. They could swell bonuses by as much as 35% if you've been involved in underwriting deals in the debt markets. In terms of equity underwriters, they could see gains of about 30%. But across the board, bonuses are expected to jump. Barclays as well, also making some moves after we removed the cap here, the government did at least,
in the UK.
In terms of bonus caps here.
Yeah, so that data on Wall Street coming from Johnson Associates, and they're talking about that possible 35% pop. And you're right, it's different in different sectors, but they talk about debt underwriting. Also, equity market M&A, if we are going to go back to that. We were talking about private equity with dry powder and wanting to get deal flow moving again. So we'll see whether that comes to pass, especially if rates drop a little bit. But on the UK side of things as well, yes, this Barclays move follows others in the sector, doesn't it? And it's a year ago since we got the then Conservative government removing the cap. It was a European Union legacy policy. They removed it, and the Labour Party said at the time they wouldn't oppose that or stand in the way of it, or reverse it, rather. Once they came into power, they did come into power, and so no sign that that changes. So now we could see bonuses at Barclays going to 10 times earnings for some risk takers, a very narrowly defined group of people, I think. So we could see that. Of course, that won't be the case for most people at Barclays, but that is what we're learning about the bonus story.
Yeah, potentially 10 times, as you say, base salary for those at Barclays within that category. Goldman Sachs, JP Morgan, as you say, also removing that cap on bonuses. OK, let's talk about the Olympics a little, shall we? 8:31 here in London, 9:31 in Paris, and the Paris Olympics wraps up on Sunday, which has been globally seen as quite a success, with spectators enjoying iconic open-air competition venues at the Eiffel Tower, Versailles and across along the banks of the Seine. But after the Games, what will be the legacy for Paris? Time to start thinking about that a little. Let's bring in Bloomberg's Benoit Berthelot, who is in Paris for us, has been enjoying the Games. Maybe not. Maybe it's not your favourite thing, Benoit. How good has it been for Paris, though? How much benefit has it brought to Paris?
I did enjoy it a lot. I've seen many of the games. It's been great for Paris. Look, people have been a bit skeptical about the games beforehand because they were told it would be difficult to move around. There could be security issues, etc. None of that happened. Quite the contrary. Like it's been good for the city in terms of security, transports. So far, some Parisians left the city and are now coming back to enjoy the rest of the games because they don't want to miss out the party. And of course, many visitors from around the world have been here, sort of replacing the usual tourists coming to Paris during the summer. So all in all, it's not a massive increase of people coming, but it's different tourists spending more as well on these Olympics. But obviously the mood is great in France right now. It's been a few months of very difficult political issues that are now sort of on pause during the Games.
Yeah, the mood, and everyone I know who's been there has said that the mood is fantastic on the streets and around the venues as well. Benoit, what do we know about the impact on business then? Business in Paris, business in France, and the global sponsorship element of that? What do we know about the economic impacts of this?
Yeah, so of course it's a bit early as the games are wrapping up on Sunday, but it's been known for every game that during the event, of course, there is some business that are doing very well because they are clearly benefiting from the games. Other ones are sort of blocked from their business as usual. But the data we have, for example, from Visa, who is a partner of the game, they saw 26% of increase of sales for the small businesses in Paris. And there are many sponsors who are hoping to benefit from the games. For example, LVMH, probably the biggest of them, spent 150 million euros on the games, and they certainly wanted to make the most of this sponsorship, were showcased in the opening ceremony quite heavily, are spending a lot of ads, etc. So these types of companies certainly want to see a longer impact of the game. Now, there are others like Airbnb who just saw mixed results globally. So it's sort of an investment for these companies. They're hoping that more people will come to Paris in the following months and years. Same for example, Disneyland in Paris. Disneyland has said that the games sort of disrupted the normal interest in their parks, but it's sort of a longer term impact that could be expected.
Yes, certainly, the closer you looked, the more you saw LVMH, for example, in different parts of the games, like the medal ceremonies, for example. And I just see orange shoes everywhere. I mean, this is also one of the marketing pushes, perhaps, at this games from those makers. Let me ask you about the legacy of the games, then, Benoit. Let's get to that, because I mean, back in 2012 in London, this was a big conversation, even satirised in comedy shows. The legacy of the games, what would it deliver? What is the thinking in Paris about how long-lasting positive impact will be?
So the Paris tried to do lower cost games, right, with all these venues that are temporary, that were in the heart of the city. Few stadiums have been built, only one small stadium and a swimming pool. So it's mainly 2 areas that have been built for the Olympic Village and some other installations. That's going to be a new housing in these sort of newly developed areas of Paris. And then there were many improvements in the transport system, for example, that have just been ready for the games and that people are going to enjoy afterwards. The biking lanes, etc., are also post-COVID new features of Paris. And then there is the Seine River. Paris invested a lot in improving the quality of the Seine. It's just been ready for the games. In the end, they were able to swim in the Seine, but that's going to be a benefit for the city for the years to come as well, people hope.
OK, yes, they were able to swim in the Seine, not always on the days they had planned. But anyway, it happened. Benoit, thank you very much. Benoit Berthelot in Paris for us. Let's turn to, in fact, I should tell you that coming up next hour, we'll be speaking to the Amazon Web Services EMEA Managing Director about that company's involvement in the Olympics. So keeping with that Olympic theme, that's at 9:40 a.m. London time. Let's get to then, Tom, some of the movers that we have on markets this morning. Yep. It's not a day for many individual standout stories, but we certainly have some M&A in the markets, and Hargreaves Lansdown is one of those. We see CVC and Adia agreeing to buy Hargreaves Lansdown in a £5.4 billion deal. The stock is up by 2.2%, we see, as a result. That's the move that we're seeing in this, private equity suitors coming after this UK investment platform.
Yeah, and in the semiconductor space as well. So tech getting a bit of a lift in Europe today, and you can link that back to TSMC because the contract manufacturer of semiconductors came out with sales numbers earlier in the day. Those numbers in the month of July growing 45%, and the company saying that was largely down to continued strong demand for those AI chips. So companies linked to TSMC, like ASML, getting a bit of a lift this morning, quite modest, but up 0.6%. Of course, that company provides much of the hardware that TSMC needs to churn out those chips. And ASM International, ASMI, also in the Netherlands, gaining as well in the session, 1.8%. So the tech and the chip makers here in Europe getting a bit of a lift on the back of those numbers coming through from TSMC.
Yeah, so that's tech. The read across from the Nasdaq and the TSMC story, as you say. Let's talk about Generali in the insurance space. A second quarter profit drop, 24% from a year earlier. Claims from storms and flooding in Europe are the negatives. Those are the things that weighed on the numbers. So as a result, you see the stock is down by 1.7%. The CEO says that he's focusing on insurance segments with high margins as he's seeking to follow through on a pledge to achieve annual earnings per share growth of 6 to 8% in 21 to 24.
From insurers then to groceries, takeaways, Just Eat is up, as you can see, 4.4%. One of the top gainers, in fact, of the session after an upgrade from Morgan Stanley, raising their view on Just Eat to overweight, raising their recommendation to overweight. They set a price target of 129, so it looks like an increase of about 24% from the last price. And investors welcoming that upgrade coming through from Morgan Stanley on Just Eat takeaway. Coming up, Donald Trump and Kamala Harris. Well, they finally agreed to debate. It's taken a bit of wrangling as the Republican, of course, is looking to shift the race for the White House after arguably Kamala Harris has hogged the limelight over the last week or so, and Trump has tried to reset that, and they're agreeing on this debate as well. The details on all of that next. This is Bloomberg.
Democratic nominee.
We're in Atlanta, Georgia. When President Biden was on the ballot, Democrats had basically conceded to losing the state. Now that it's Vice President Kamala Harris, Democrats say all 7 swing states are back in play.
Kamala Harris is well known, but she is not well defined.
She's not somebody I've researched too in depth.
She's kind of laid low, but
That's kind of what vice presidents do.
You're going to see both Democrats and Republicans defining her in the ways they want those voters to see her.
Success for Harris will mean sustaining the momentum that's been fueling her historic run.
I get chills when I think about that, just being a part of history, understanding that we have someone who represents our communities.
She's also like a really dynamic candidate, especially for like younger people like us.
People, if you asked a month ago, they probably would have said that the country is not ready. But now people are rethinking that, and they're like, oh my gosh, this could actually happen, and I could be a part of it.
OK, you can read more of our Big Take story on swing states online at Bloomberg.com or, of course, on your Bloomberg terminal. Now, Republican presidential nominee Donald Trump has agreed to debate Democratic rival Kamala Harris in September. Speaking with reporters at Mar-a-Lago, Trump criticised Harris for avoiding media interviews since securing that nomination.
She hasn't done an interview. She can't do an interview. She's barely competent, and she can't do an interview. But I look forward to the debates because I think we have to set the record straight.
I'm glad that he's finally agreed to a debate on September 10th. I'm looking forward to it and hope he shows up. I am happy to have that conversation about an additional debate for after September 10th, for sure.
OK, and that was Kamala Harris speaking on the question of that debate and saying she would agree to it. Still waiting, of course, for the final details as to where that lands. But we are reporting that the Democrats and the team around Kamala Harris have refused, at least ruled out, that debate taking place on Fox. Let's get more on this story and how the politics has evolved, as it does rapidly in the US right now, with our senior writer at Bloomberg, Stephanie Baker, who keeps, of course, a firm and close eye on all things US politics. So Harris and Walz pulling in these huge crowds, and our team on the ground who have been attending them saying that they do compare to the kind of rallies that you see and the kind of enthusiasms you see from Trump rallies. Certainly a long way from what Biden was pulling in terms of the attendance, the enthusiasm. You have celebrities on stage as well in the warm-up acts. Is this sustainable, do you think?
Yeah, it's really interesting because people are now comparing the kind of crowds that she's pulling in to the enthusiasm behind Obama in 2008, that we haven't actually seen this kind of energy in the Democratic Party for over a decade, almost 2 decades even. So I think that it's a question, can she keep this up? Obviously, you win elections not just by enthusiasm and energy on the campaign trail, but at the ballot box. So, you know, the crowd size, you know, doesn't matter that much at the end of the day. So I think it's important to still keep an eye on the polls.
Yeah, it reminds me of when you go to party conferences in the UK and people say, well, it went down really well in the room. And you think, well, of course, it goes down really well in the room, but it's how it goes down in other places that maybe matters more. Critics then complain that Harris has avoided interviews. We just saw her taking a few questions on the tarmac there. Is this a valid concern? Is she not answering questions that people have as frequently as you would expect somebody to in this position?
Yeah, well, the Harris camp response to that is that she's only been the nominee for 2 weeks, and she's had a very busy schedule. She had to pick a VP. She had to, you know, plan for the convention and plan to introduce, you know, Walz to the nation, and that she will be giving interviews in due time. So we'll wait to expect that, you know, in the coming weeks, perhaps after the debate. I'm not sure, you know, maybe before. I think the real question is, you know, how does she perform when under pressure on the big policy issues? Can she keep up that kind of momentum that she has on the stump? She gives great speeches at these rallies. She's really able to kind of, you know, rile up the crowd behind her. Can she withstand the pressure under scrutiny?
And we'll get a better sense, I would assume, of that question when they do this debate. And it's been agreed. So September the 10th is the debate time, and we've obviously been reminded this year of just how crucial those debates can be. What is your thinking around that and how that could evolve, how consequential that could be?
Well, you know, the political roller coaster that we've been on for the past month has just taken everyone by surprise with twists and turns that no one could have predicted. The debate is obviously very consequential, could be as consequential as the debate between Biden and Trump that upended the race. I think both Harris feels confident and has been demanding Trump agree to this debate. Trump finally did, in fact, agree to it. Is he able to stick to the script, or does he go off off into meanderings like we saw at the press conference last night and attack her in a nasty way that backfires on him. That's the thing to watch.
Yes, and talking of that press conference yesterday, what did you take away from that? From the market's perspective, a lot of focus on things he said about the Fed and how he should have other presidents, but also just him, how he should have more of a say on what interest rate policy looks like in the US. But away from, I mean, is that what you took away, Stephanie, or were there other things to watch?
It was so meandering, and he lied so many times. Everything from, boasting. He seemed obsessed with his crowd size, and I think that the crowds that Harris has been able to pull out seems to have really rattled him.
And that goes right back to when he was first inaugurated, doesn't he? That was a big debate.
Exactly.
The size of the crowd that attended that.
And the most incredible thing is when he compared his January 6th crowd size to Martin Luther King's I Have a Dream speech, which people thought was really, beyond the pale. I think some critics are saying that the sign that he called this press conference is, the best signifier that he is really rattled by the Harris campaign and wants to try to regain the limelight and feels comfortable giving these sort of meandering press conferences as a way of, regaining attention.
Stephanie, thank you very much. Thanks for joining us. Bloomberg senior writer Stephanie Baker, all across the US politics for us. Maybe we've taken our eye off that a little bit, given the volatility we've seen in markets over the past week, not driven by US politics. Maybe we leave that for the run-up to November. Plenty of time for that, of course. With thinking about that volatility in markets, the Monday mayhem, the Tuesday turnaround, Wednesday's whipsaw, what was Thursday? I've forgotten what Thursday was. Turnaround Thursday, takeoff Thursday.
Takeoff Thursday.
I think that was it, yes. And maybe flat Friday is appropriate. Certainly looks like it for this hour of the day, although it is very early in the States. But US futures are pretty flat. We're through some of the big data points of the week, so we will keep an eye on those, though, as we get closer to the US session. Bloomberg's Connor Cooper joins us on set with thoughts on the week that was, and what a week it has been. Connor, nice to see you.
Nice to see you.
Market volatility then, Monday we had lots of it, and the VIX took off to levels that seemed kind of crazy compared to other periods of risk in the last 20, 30 years for US markets. What did you make of the volatility story?
Yeah, it's sort of a whole month's worth of action crammed into one day. I don't think we'll see many days like Monday again. What I do think we will see, though, is... sorry.
That's OK. Go ahead.
What we are going to see is
week.
that move's going to be sort of spread out. The direction of the move is probably going to continue again. We saw... Because the reason the move happened, the three reasons... Sorry, I'm feeling a bit unwell.
OK.
So
we can maybe cut it short.
Take a breather. Yeah, it has been a big week. But
it's been a big week.
It's been really challenging, and you've gone through, of course, this week, Anna, for us in terms of just how things have adjusted on the equities front and fixed income as well, and the turnaround, and now the adjustments in terms of the views around the Federal Reserve. And we'll get a better steer of that, of course, next week when we get that inflation data out of the US. It's going to be really consequential. The retail sales number as well out of the US in terms of what the consumer is doing stateside and how much strength that they still have. And here in the UK as well, inflation out of the UK. So it's not going to be a quiet week next week either. Unlikely to replicate the kind of moves we've seen this week in terms of those spikes around volatility. But again, consequential in terms of getting more clarity, we hope, in terms of where these central banks go from here and how markets adjust.
Yes, absolutely. In terms of what we're looking at next week, you've been through some of these topics. We've got the inflation prints on both sides of the Atlantic, as you say. CPI in the United States will no doubt be in focus. We had that labour market data that shook confidence on Friday. And then yesterday we rediscovered some confidence thanks to a week of jobless claims. So there's a lot to think about there. Although I really liked the line from our UBS guest earlier on today, Tom, talking about how the whole thing has just been one big head fake.
Yeah.
We overdid concerns about the US economy at the beginning of the week, and that's really what led us into this whipsawing that we've seen. But then it's not only in the US we'll get the data. The UK will have inflation data here as well, and the wage story. The inflation data will be interesting because it will tick up. That is the expectation, and a lot of that is due to fuel prices, and it's a sort of a base effect of fuel prices, but it's services inflation that really matters more. So, yeah, we'll be looking for clues for the BOE there. And
the tension has been there at the MPC, hasn't it, between the hawks and the doves? It's very, very finely balanced. They went with that cut, of course, so you're back to 5% from 5.25%. But to your point, will stronger inflation data out of the UK lead to a question mark as to how aggressively the BOE can go from here? You were talking about the head fake line from our UBS guest. We were hearing from our Goldman Sachs guest as well in terms of the historical perspective when it comes to the start of these rate cut cycles from the Federal Reserve and what that means for small caps. And he was quoting a number. Historically, you see gains, I think, over a 12-month period when the cuts start for small caps of between 14 and 15%. UBS and their CIO of Wealth saying that if you look historically, you see gains for the S&P of about 17% historically after the start of cuts. And that's why at UBS they remain constructive on these markets.
Yes, they were saying 3 months, 6 months, 12 months. It all looks favourable for stocks when you see these bouts of volatility. So we've had a lot of debate then about the US economy and whether those cracks really are taking us to a hard landing or whether a soft landing is still in store. Let us recap what we've heard from some of our guests talking about the possibility of a recession in the US.
I do believe there's resilience in the U.S. economy.
We do not yet see any sign of having the economy move in recessionary territory.
There have been several calls for U.S. recession. In fact, they've just turned out to be corrections with a resumption of growth.
I do think that we're getting a correction here after a very strong run on the markets, and that might be healthy.
We don't see a recession coming soon or coming. Actually, we think that the economy is still strongly set.
We probably all have to live with more volatility than we are used to. But overall, I think the trend is our friend and the trend is showing upwards.
Ahead of the elections, obviously, maybe the market is a little bit muted. But all in all, the United States was always a market which was quite resilient.
The U.S. economy is a little bit stronger than people are giving it credit for, and the consumer will come back as the economy continues to strengthen.
The economy will chug along and we probably won't see a recession.
Some of our guests there talking about the possibility of US recession. Interesting then, Tom, that we had comments there from European corporates like Siemens saying emphasis on the resilience. I should also point out for viewers who are wondering about Connor, he's okay. He's gone back to his desk. So Connor Cooper, who we brought on briefly, is okay. But that's the story then out of the US economy from the European corporates right now. They put the emphasis on resilience.
Yeah, and the sense is, again, look, don't write off this US economy. And again, from Goldman Sachs Asset Management, our guest earlier saying, look, even if you move lower in terms of growth for this year from 1.5% to 1%, you're still getting decent growth. The jobless claims yesterday, of course, led to the market rally that we saw with the S&P notching gains that we haven't seen the biggest pop since November 2022 because the jobless claims were slightly lower than the estimates. So again, the labour market, yes, it's seen a few cracks, but a number of our guests have said there is still that resilience there. You're not close to that recession, even if, of course, JP Morgan, Goldman Sachs have increased their odds, their chances of a US recession. It's still not the base case. OK, so that's not the base case. In terms of the movers then today, we've got some upside in Hargreaves Lansdown, private equity coming in for that business. Of course, we've seen that have an impact up by 2%. The tech sector in focus as well, Tom? TSMC coming out, of course, over in Taiwan, but there's the tie to the European players, the providers of equipment, of course, to that contract chip manufacturer. They came out with some really decent sales numbers, suggesting that demand for generative AI is still there. So the likes of ASML and ASMI over in the Netherlands are getting a lift on the back of that story.
OK, those are the movers then this morning, this Friday. US futures flat, yes, but a little bit more positive than they were. So we'll keep an eye on those as we bring this incredibly busy week to a close. That is it for the opening trade. The Pulse is up next. This is Bloomberg.